Welcome to On the Money, the video series where Wilkins Miller experts share updates, tools, and tips to help your business achieve more. I'm Jeffrey Kintz, and I'm a tax manager with Wilkins Miller. I help business owners and individuals with all their tax planning and compliance needs so they can focus on what matters most, growing their business. In this episode, we're talking about tax withholding, estimated tax and extension payments, and how understanding them can help you avoid surprises and penalties. If you're an employee who receives a W-2, you generally pay your taxes throughout the year out of each paycheck. The amount taken out is based on the form W-4 that you fill out when you first start your job. It can be updated as life happens, whether it's getting married, having a child, or picking up a second job. If you're self-employed, own a business, or have a significant amount of income outside of your regular paycheck, you may need to make quarterly estimated tax payments. Both withholding and estimated tax payments are designed to help you pay your taxes as you earn income, but there are some important differences. Withholding happens automatically each time you get paid, so it can be easier to manage if your income is fairly consistent. Another benefit of withholding is the IRS treats these payments as evenly paid throughout the year, even if more tax is withheld at the end of the year. For example, if you receive a bonus at the end of the year, withholding more on that bonus may help you reduce or eliminate interest and penalties. On the other hand, estimated tax payments require a little more planning, especially if your income changes throughout the year. The IRS does have rules that can help you avoid penalties. Depending on your income, paying at least 100 or 110% of prior tax can help you, even if your current year income is higher. So, how much should you have paid in throughout the year to avoid surprises? Ideally, you don't want to end up with either a huge tax bill or a large refund. The goal would be to get to as close to zero as possible. In other words, you want to pay in enough throughout the year to avoid penalties, but not so much to be giving the IRS an interest-free loan. Of course, hitting that number can be difficult. Your income, deductions, and personal circumstances may change throughout the year. And there's one last thing to keep in mind. Filing a tax extension gives you more time to file your actual return, but it does not give you more time to pay what you may owe. If you expect to owe taxes, making an extension payment by April 15th can help reduce unnecessary interest and penalties. If you have questions about your withholding, tax payments, or whether you're on track for the year, the Wilkins Miller team would be happy to help. And that was On the Money.